Hey everybody, Joe here from Avalon Accounting. We get a lot of questions about incorporation and how to pay yourself when you own a business. But instead of just talking through general pros and cons, we're doing something a little bit different in this video. We're going to walk through a few real-life business scenarios and break down what we do in each case. We'll look at whether it makes sense to incorporate, and if you're already incorporated, how to decide between paying yourself a salary, dividends, or a bit of both. This idea came from a great comment on one of our YouTube videos. The viewer said, "What if I'm a freelancer making $100,000 or $200,000? What happens if I create a company and pay myself salary and dividends?" That comment stuck with us because it's a really common situation. So we created this video to walk through some different levels of business income and show you the tax impact, the admin cost, and what we'd do if we were in your shoes. So let's get into it. And by the way, if you want personalized help figuring out this for your own business, head over to avalonaccounting.ca and we'd love to chat. All right, we're gonna look at 3 different scenarios that we often see. Scenario 1 is a freelancer making $150,000 in revenue with $25,000 in expenses. Scenario 2, a business owner making $275,000 in revenue with $50,000 in expenses. Scenario 3, a corporate business with 2 shareholders earning $1.2 million in revenue with $700,000 in expenses. We'll discuss details for each option and give you some real-world tax estimates as well. Starting with scenario 1. Let's say you're a self-employed freelancer in British Columbia making $150,000 in revenue and you've got about $25,000 in business expenses. That leaves you with $125,000 in net income. Now you're wondering, should you stay self-employed or would it be better to incorporate? If you stay self-employed, you'll report the $125,000 on your personal tax return. At that income level in BC, you'd pay about $27,000 in income tax and $8,000 in CPP contributions. The high amount of CPP is because you're responsible for both the employee and employer portions of CPP when you're self-employed. So you'd be left with around $90,000 in after-tax cash. This is the simplest setup, no corporate filings, no extra admin, and just some basic bookkeeping and one personal tax return that you can likely handle on your own. Plus, self-employment income also builds up your CPP and RSP contribution space, which can help you out in the future. Now, let's look at what happens if you incorporate and pay yourself a salary. There are a few more costs involved in running a company compared to operating as a sole proprietorship. So after paying around $5,000 for bookkeeping, corporate taxes, and legal fees, the company has $120,000 left to work with. That could fund a gross salary of about $116,000 with the remaining $4,000 going to employer CPP contributions. On the personal side, you'd likely pay about $25,000 in income tax and $4,000 in employee CPP. That leaves you with a roughly $87,000 in after-tax income. In this version, you're still contributing to CPP and creating RSP contribution room, but after-tax cash is a bit less than the self-employment option. This mainly boils down to the added costs of running a corporation. Now, what if you incorporate but go the dividend route instead of salary? After the same estimated $5,000 in admin costs, your corporation is left with that $120,000 in profit. You'd pay about $13,000 in corporate tax, which leaves you $107,000 to pay out in dividends. Once those dividends hit your personal tax return, you owe about $15,500 in personal tax, leaving you with around $91,500 in after-tax income. So this is the highest take-home option today, but there are 2 big trade-offs. One, you don't pay into CPP, which means less retirement income down the road. And you also don't create RSP contribution room when your income is all dividends. So while it's efficient now, it might not support your long-term financial plan the same way salary or self-employment income would. Now, if we were earning $125,000 in net income as a freelancer, we'd likely stick with being self-employed for now. The tax savings from incorporating aren't very significant once you factor in the extra admin costs. And as a sole proprietor, you get to keep things simple and still build up CPP and RSP contribution room, which helps with retirement planning later on. That said, taxes aren't the only thing to consider. There are other factors that might make incorporation a good move, like limited liability protection. If you want to explore those details, check out our blog post on whether or not you should incorporate your business. And if you're staying self-employed for now, we've got two great free resources to help you. Our free bookkeeping template makes it easy to track your income and expenses. And our guide on how to file your tax return for free walks you through the process step by step. You'll find all the links to those resources in the description below. All right, now on to scenario number 2. Let's look at someone who's running a more established solo business. Let's say you're bringing in $275,000 in revenue and you've got about $50,000 in business expenses. That leaves you with $225,000 in net income. This is where incorporation starts to become more interesting. So we'll walk through how things play out if you stay self-employed and how they compare to the corporate options. So if you're self-employed in BC and earning $225,000 after expenses, you'll pay around $70,000 in income tax and another $8,000 in CPP. That leaves you with about $147,000 in after-tax income. You'll also need to stay on top of your own bookkeeping and personal tax filing, but there's no corporate structure to manage, which keeps things relatively simple. The upside here is that your self-employment income still builds that CPP contributions and RSP contribution room, which can help with retirement planning. Now let's say you decide to incorporate and pay yourself a salary. After setting aside $5,000 for bookkeeping and legal costs, your corporation has $220,000 available to cover your salary and employer CPP. That allows for a gross salary of about $216,000 and $4,000 in employer CPP contributions. On the personal side, you'd pay around $67,000 in income tax and $4,000 in employee CPP. That leaves you with about $145,000 in after-tax income. So it's just slightly lower than the self-employed option, mostly because of the added corporate admin costs. But like self-employment, you're still contributing to CPP and building RSP contribution room, so there's a long-term value there too. What happens if you incorporate and pay yourself entirely in dividends? After subtracting the $5,000 in admin costs, the corporation has $220,000 in profit. It pays about $24,000 in corporate tax, leaving $196,000 to be paid out as dividends. Once that hits your personal tax return, you'd owe about $48,000 in personal tax, and that leaves you with around $148,000 in after-tax income. So this ends up being the highest after-tax income of the three options, but again, there are a couple trade-offs. Number one, you're not contributing to CPP, so you're giving up future retirement income. You also don't generate RSP contribution room with dividend income. So if you're thinking about short-term cash, dividends do come out on top. But from a long-term planning perspective, missing out on CPP and RSP contribution room could be a major drawback. Now, if we were earning $225,000 in net income as a sole proprietor, we would start to consider incorporating. At this level of income, the benefits of incorporation may begin to outweigh the costs, especially if you're willing to grow the business, build some savings inside the company, or just want some flexibility in how to pay yourself. We would then do some calculations and either pay all salary or a mix of salary and dividends to strike a balance between tax efficiency today and retirement planning for later. And just like in the last scenario, you'll find links to all our detailed posts on incorporation and salary versus dividends in the description below. All right, moving on to scenario number 3. Let's say you've got an incorporated business with 2 shareholders. Both of you are active in the business and you're earning $1.2 million in revenue with $700,000 in expenses. That leaves $500,000 in net income to split between the 2 shareholders. We're going to look at 2 common options for paying yourself, salary or dividends. So let's say you decide to split that $500,000 evenly through payroll. That allows for a gross salary of $246,000 each with about $4,000 in employer CPP contributions per shareholder. On the personal side, each person would pay around $81,000 in income tax and $4,000 in employee CPP. That leaves around $161,000 in after-tax income per person. Now with this approach, you're both contributing to CPP, which gives you some retirement income later in life. You're also creating RSP contribution room based on your earned income, which can help you reduce future tax bills and save for retirement. Now let's look at the dividend-only route. If you don't run anything through payroll, the corporation would pay about $55,000 in tax on the $500,000 in profit. That leaves $445,000 to distribute as dividends. Now split evenly, that's $222,500 in dividends per shareholder, and you'd each pay about $59,500 in personal tax, which leaves $163,000 in after-tax income. So your take-home cash is slightly higher than the salary option, but there are those two key trade-offs. You're not contributing to CPP, which means no future income from the Canadian pension plan. You're also not generating RSP contribution room since dividend income doesn't count towards earned income. So while you're getting more cash in your hands today, you're missing out on some long-term financial planning advantages. In a situation like this, we'd likely go with paying full salaries to the shareholders instead of using dividends. We did run some preliminary calculations, and at this level of income, a mix of salary and dividends actually ends up being less tax efficient than just paying salaries. With full salaries, the after-tax income is slightly lower than the dividend-only option, but you're contributing to CPP and creating RSP contribution room, which adds long-term value. It also keeps the compensation structure simple and transparent, especially if both shareholders are actively working in the business. All right, that does it for this video. Hopefully walking through these real-world scenarios helped you see how incorporation and pay strategies can play out in practice. There's no one-size-fits-all answer, but understanding the tax impact, long-term planning considerations, and how each option affects your take-home pay can make a big difference. So if you want more details, we've linked to some helpful resources in the description below, including our post on incorporation, salary versus dividends, and a couple of free tools if you're managing things yourself. And if you're looking for advice that's tailored to your situation specifically, we'd love to help. Head on over to avalonaccounting.ca to get in touch. Thanks for watching, and we'll see you in the next video. Cheers.